Hey guys, Brian Stevens over here at Mortgage Shots. I got my good friend Chris Martin, the co-CEO over at Oaktree, the only NonQM company you guys should be working with. We're going to talk about a couple of things that I think could help your business, so stick around with us here. First, I want to talk about saving deals. This is a conversation that we've kind of booted and rebooted a couple of times, but I don't think people really understand the importance of it. How can NonQM and Oaktree help loan officers and realtors save deals? Since, they're scarce right now, why wouldn't you?
You know, what's interesting is that that's not just about saving deals, but I was looking at our rate matrix and talking to one of our AEs. We were at a conference yesterday, and he said that he was telling me that broker came over to him and was talking about an investment property that they were doing, and they could get pricing through conventional. It was 7 5/8, and they were paying 2.5 points in discount and everything else. And he ran the pricing for them and was able to get them a 7 1/8 rate for their scenario at par. And the difference was it just had a prepayment penalty, which the borrower didn't care about because they're buying the investment property to keep it long term. So the pricing is one quick way that could save deals. Not agency, as we've talked about, as you've talked about many times, Fannie Mae and Freddie Mac are pushing back on investment property, so they don't want them. So their loan level price adjustments are set in such a way that to not get those loans. So we have pricing that we want them. Our investors that we sell loans to, the investors in the secondary market and bond market buyers, love investment property loans. They like them because they have prepayment penalties on them and they're going to stick. So that means that the 7 rates, maybe in September, if the Fed cuts rates, they're still going to be able to collect payments and collect their interest at the 7% interest rates. And if people want to pay off because the rates get a lot better, then they're getting the prepayment penalty. So they get the early interest and they get to go refresh their money again. So that's
So you could actually go ahead on investment properties. In many cases, you can get better pricing than just going with your agency loans.
Yeah. So if your borrower is shopping you and you're thinking, oh man, they're a conforming borrower, they don't need to go non-QM, they don't need DSCR. They might check our pricing out. There's many situations and many scenarios where we can do as good, if not better, than agency as far as pricing goes on your investment property. That's just one area.
Now, one thing that always kind of, when you said it was an aha moment for me. It's really being able to use income that you otherwise wouldn't be able to use on agency deals. Can you boot that up?
Yeah, well, first of all, it's you're getting income on which you wouldn't be able to on agency deals. We can run these loans as DSCR loans. So as long as the property pencils, we can get in it. And that's what I'm talking about. I'm not talking about, oh, hey, we have to go through all these tax returns and got to get the DU approval and all that kind of stuff to get the better pricing on the non-agency product. And there are programs like that out there. We just do DSCR loans. We don't, that loan that I referenced, the 7 1/8 rate, was a DSCR loan, wasn't a full doc loan, wasn't a bank statement loan, wasn't a full doc loan, wasn't any of that stuff. It's just using the property to pencil. And if, by the way, the property that you're buying doesn't pencil, and you're going to be able to, you think you can make improvements to it or whatever, and you can raise the rent over the next few years, you're buying it because of the location, whatever the reason you're buying it for, and it doesn't pencil today, we can go down as low as 0.75 DSCR, or we can use regular full doc income, or we can use bank statements to qualify for investment property. So you're not beholden to this one specific method to get your investment properties done.
What if it's on a primary residence and you have like a teacher who's got months off here, or a firefighter who's 3 on 4 off, and they have other income that you can't use for qualifying purposes on your conventional loans? Yep. But if they went on a bank statement loan with you, you can go ahead and use that and pull your ratios down.
So if you have, let's say to your point, you got a teacher that to supplement their income during the summer, because that's not against their contract to work, they teach kids how to shoot basket. They're self-employed. They have their own basketball shooting LLC company, and they've been doing it, and they have that on their income docs, and they have that in their bank statements as deposits. We can use that income. If you've got somebody who drives Uber or Lyft, or listen, teachers don't make a lot of money. They might be doing something all year round that you want to be able to use. So, and it's sad they don't, obviously, but the facts are the facts. So if you can find other areas, teachers are finding other ways to bring in income, we can use that income. No, not a problem.
Now, let's change gears real quickly. I literally just got off the phone with a non-QM company who called me. I get a phone call like every third day from a new non-QM. They're popping up all over the place. People are occupying and jumping into this space on a regular basis.
Yep.
Is there anything that a loan officer might be a little weary of before they decide to go with a Johnny-come-lately?
Listen, to be honest with you, we're buying loans from those people probably. and we're not a big correspondent buyer. We're not a national buyer of those loans. They're coming to us because they have very limited outlets where they can sell their loans to. We're a wholesale lender, and we do non-delegated correspondence. So if somebody's coming to us that are doing wholesale loans, we're underwriting the loans for them also. And very much that's what you're going to see. They don't have the investor relationships that we have. They don't have the backing that we have. They don't have the support that we have. They don't have, competition's competition. Angel Oak, these guys that have been there for a long time, and you guys, those guys. I mean, we're friendly competitors. We see each other at trade shows. We shake hands. How you doing? Whatever. But we're trying to, we know what we're doing. We know how to make exceptions. We know how to make loans work. We know how to do the things that we need to do to get loans done. And we've been in the space. We know what's going on. We've been here since 1989. We've been doing non-QM loans since they came back in 2014 with ACRA. And with Angel Oak, if you want a mainstay non-QM lender that knows what they're doing, knows how to make exceptions, and can get loans done, Oaktree is the answer to your question.
You brought the term up, exceptions, twice, and that's kind of dear to my heart because, doing FHA loans, back in the day where you had manual underwrites, you could actually sit down and go through the guidelines with an underwriter, and they had the ability to go ahead and make what would otherwise be an exception for them. That's long gone. People don't understand the importance of that. Loan officers who are new to the game, explain what exceptions actually mean.
That's a great point. We used to make exceptions on FHA loans when I first started working at Oaktree. They were called manual underwrites.
Yep. Yeah.
So some places I guess still do them, but they're few and far between, and nobody wants to take risk, and underwriters don't want to put that on their if they have an audit or something. But so we have exceptions. We have an exception tree that we use. That if you look at it, you look at our matrix and you look at our LTVs and you look at the FICO score, you can say, man, I wish we could get 5% more loan to value. Well, if your guy has compensating factors, if he's been on the job a long time, or he's got excess reserves, or he has whatever the case is, we can usually go 5% higher in LTV. Now we can't go from 90 to 95, but we can go from 80 to 85 or 85 to 90 in some cases. So there's lots of, or if it's a large loan size, let's say our matrix says, hey, up to $2 million, we can only do, 70% loan to value, and you have excess reserves. Very many times we can get to 75%, sometimes even higher. Just depends. We have great relationships with our investors. It's a phone call. In some circumstances, if it's a huge loan, we do some loans. We go up to $4 million by guideline, but sometimes people need more than that. So those are calls to our investors, but that's it. They don't need to underwrite the file for us. It's a conversation. And that's it. We very many times get a lot of these exceptions approved. 90% of the exceptions we make in-house. Our operations, our COO makes the exception call. And then if it's, he doesn't feel great about it, he brings it to me and Steve, my business partner, and then we'll make a decision on that. But, I actually met with one of your fans yesterday. He stopped me in the hallway. He's like, oh, you look familiar. Where do I know you from? Oh, your voice, it sounds familiar. Where do I know you from? Oh, you do that show with Brian Stevens, right?
That's awesome.
Yeah, but he said, the one thing that stands out with you guys, and one thing I like the most about Oaktree, and really why I wanted to do business with you, is because you say two things that make a lot of sense to me, and those two words are common sense. And we do common sense underwriting. That's how we approach every single deal. Does it make sense? Is it the guy that's been on the job for a long time, and we know he's going to have this income continuing, and we know that these things are going to happen because he's shown a previous history of this, and does it make sense to go a little bit out of the guidelines because, he doesn't have as much in reserves? The reserves are funny, right? Because, hey, especially, a lot of lenders, including us, we'll use cash out for reserves to help meet our reserve requirement. But so they didn't have reserves before. Now we're giving them cash, and now they have reserves. What are they going to do with that money? They're going to spend it. We understand that reserves are only as good as, tomorrow or maybe the first few payments. But when we're really looking at the character and the credit of a borrower, how long have they been on their job? What kind of job do they have? Are they self-employed for 1 year and they've only done whatever they've been doing? This is a brand new venture for them, or is they're a doctor that started up their own practice, right? And because we know that if a doctor's practice shuts down, what are they going to be able to do?
Be a doctor
somewhere else, and they're going to make commensurate income.
So this is really kind of, this is where, being in the industry or this space since 2014, having these relationships, you can go ahead and make these exceptions on files where other companies can't.
Right.
So, and that's
a long way of answering that question.
No, but it's really, really important. One of the other things I know that Oaktree's fantastic at is pricing. That's what LOs are all going to want to know. What you just told us a couple of moments ago is you're beating, agency in some cases when it comes to investment properties because these are loans that your investors want. You have that relationship. What's your approach towards pricing when it comes to non-QM in general?
We want to be competitive. We want to be profitable, right? We want to be here tomorrow. We want to be able to support our employees. We want to be able to support the communities that we're in, be able to give back and give service. And in order to do that, we have to be profitable, just like all of you listeners need to be profitable. But that said, we're not going to lose a deal of price, right? Especially, listen, we work with, if your loan is between the $350 to $2.5 million range, there's not a chance we're losing that deal of price. There's not anybody else out there in the market that can touch where we can go on those loans. And you should bring every single one of those loans to us, because not only we're going to give you the pricing that you need to compete for your customer, but we're also going to make sure that you have the service level that you need to be provided so that your customer doesn't just close the loan with you, but they also want to refer you to all their friends and family. We understand where we're at. We are your extension to the capital markets. We're your extension to give these borrowers money for their loans so they can meet their hopes and dreams. And if we can give you a great quality of service, you can give your borrower a great quality of service, and they're going to give you another referral. And that's how many of our customers live. They live on that referral business. And we understand the importance of that, and that's what we want to do. So if you bring us if you trust us with your borrowers, we're going to give you the best price and the best service that we absolutely can.
Pricing, products, exceptions, these are all great things. Now, I got to tell you, this is such a huge part of my business and what I'm doing right now, and it's penciling for me in such a remarkable way. I love Truly. Absolutely love Truly. Guys, reach out to me if you want to learn more about Truly. This is fantastic. We had a conversation just a couple of moments ago, and this is a completely unique opportunity for anybody who's watching this video right now. But if you want to look at another vertical to earn money, Truly might have an option for you through Chris, because that's a subsidiary of Oaktree. Can we talk about that for a second?
Yeah. So through one of my other LLCs, KM Capital Management, we have, Steve and I, through his, we have started a fund called Truly Special Purpose Vehicle 1, or Truly SPV 1. If you're interested in investing, you can earn up to 10% interest on the fix and flip loans that Truly is purchasing, or Truly is funding. You can get up to a 10% interest rate. We don't charge any fees, none of that stuff. We have dividends that are paid quarterly. The caveat is that you have to be an accredited investor. What that means is that you have to earn over $250,000 a year annually if you're single, or $300,000 if you're married, or you have to have over $1 million in investable assets. That means you can't use your home equity to qualify for that net worth rule. So if you're interested, give me a call. You can call me toll free at 888-404-0052, or you can email me at kmartin@kmcap.net, and I'd be happy to get in contact with you, go over the pitch deck and any questions that you have if you're interested in investing.
Good stuff. Chris, thank you for your time.
Thank you.
Chris, thank you so much for your time.
Thank you.